Hello everyone, this is Victor here. Welcome to the Intelligent Investor channel, where you will learn about stock investing and personal finance that will help you become a great investor. In my last video about Alibaba, I talked about why I believe Alibaba will eventually reach 1 trillion in market cap or $382 per share. But several major political events happened right after I made the video. So in this video, I will give you an update to talk about Alibaba's major political risks right now and how these risks may impact Alibaba's long-term growth prospects. Specifically, I will talk about the anti-monopoly probe on Alibaba. Will Alibaba get delisted from US exchange, and how will Ant Group's suspended IPO impact Alibaba? In this video, I will cover these topics. First, stock overview. Second, company overview. Third, risk number 1, anti-monopoly probe on Alibaba and how it will affect Alibaba. Fourth, risk number 2, will Alibaba get delisted from the US stock exchange? Fifth, risk number 3, how will Ant Group's suspended IPO affect Alibaba? Sixth, will Alibaba's long-term growth prospects be affected? Seventh, summary, what I will be doing with all this information. Now, if you like this video, smash the like button and subscribe, and turn on the notification button. I will continue to make many great videos about stock investing and personal finance that will help you become a great investor. Let's start. First, stock overview. I want to give you Alibaba stock overview year to date this year to show you how Alibaba stock was impacted by the 3 recent major political events, even though Alibaba's e-commerce business is doing very well. So first, right after the Ant Group IPO was suspended by the Chinese regulators this year, Alibaba stock dropped as much as 8.13% on November 3rd. Second, US Congress passed the Holding Foreign Companies Accountable Act that could delist any Chinese companies from the US stock exchange if they cannot be audited by the Public Company Accountable Oversight Board (PCAOB) within 3 years. Alibaba stock was not affected, even though many investors are worried that Alibaba could be delisted from the US exchange 3 years from now if PCAOB cannot audit Alibaba's accounting records. Third, the State Administration for Market Regulation of China, CAMR, announced that it will investigate Alibaba's potential monopolistic practices. Now, many investors are worried about the consequences, so the market panicked and Alibaba dropped as much as 13.34% within the same day on December 24th. I will cover all these major political risks in this video. Second, company overview. I want to give you a brief overview of Alibaba's businesses. Alibaba is the largest e-commerce company in China. Alibaba owns many marketplace platforms and businesses, including Taobao, the largest marketplace for smaller merchants to sell directly to customers in China. Tmall, the largest marketplace for large international brands and retailers to sell directly to customers in China. AliExpress, a global marketplace that connects buyers around the world with sellers mainly from China. Alibaba.com, the largest international online wholesale marketplace in the world. 1688.com, the largest domestic wholesale marketplace in China. Alibaba Cloud, which is very similar to Amazon AWS. And Ant Group, the largest fintech company in China. Alibaba owns 33% of Ant Group. Now, Alibaba's e-commerce business has been doing very well this year, even if the stock is impacted by the current China-US tensions and Chinese regulations such as the antitrust probe on Alibaba right now. So for example, in Alibaba's recent November 11th Global Shopping Festival, Alibaba generated 498.2 billion RMB or $74.1 billion in gross merchandise volume (GMV), up 26% compared to the same period in 2019. Now I want to talk about the major political risks that are causing Alibaba stock to be undervalued in the short term. Risk number 1, anti-monopoly probe on Alibaba. The State Administration for Market Regulation of China, SAMR, announced that it is investigating Alibaba's monopolistic practices, specifically 二选一 in Chinese. It means forcing merchants to sell exclusively on Alibaba's platform and not allowing merchants to sell at other e-commerce platforms such as JD.com and Pinduoduo at the same time. Based on my understanding and prediction, Alibaba will likely get fined. Now, I cannot predict the exact penalty amount, but here is a very good indication of what the penalty will be. According to the anti-monopoly law of China, this article states impose on it a fine of not less than 1% but not more than 10% of its sales achieved in the previous year. If such monopoly agreement has not been implemented, it may be fined not more than RMB 500,000 yuan. Here's the worst case scenario. Alibaba had total revenue of 509.7 billion RMB or $71.98 billion in fiscal 2020. If a 10% fine is imposed on Alibaba, Alibaba's fine will be around 51 billion RMB or around $7.2 billion, which of course is a lot. But imposing a maximum 10% fine means that it will greatly reduce Alibaba's net profit for that year. This should be a one-time write-off for Alibaba. The fine should not affect Alibaba's long-term growth prospects. And another scenario is Chinese regulators forcing Alibaba to break up its businesses, including Taobao, Tmall, Alibaba's, and 1688.com. Now, I don't think that's going to happen. I believe the Chinese government does want Alibaba to remain a market leader in the global e-commerce market to compete with Amazon and other non-Chinese e-commerce companies, while still making sure Alibaba is still complying with Chinese anti-monopoly regulations. It will not make any sense if Chinese regulators force Alibaba to spin off its businesses, such as Taobao, Tmall, Alibaba's, and 1688.com. This will make Alibaba less competitive in the global e-commerce market. Again, the worst case scenario should be Alibaba getting a 10% fine on its previous year's total sales. I believe the stock market overreacted, which caused Alibaba stock to drop as much as 13.34% in one day. Risk number 2, will Alibaba get delisted from the US stock exchange because of the Holding Foreign Companies Accountable Act? The Holding Foreign Companies Accountable Act, HFCAA, is about delisting Chinese public companies from US exchange if they cannot be audited by the US Public Company Accountable Oversight Board, PCAOB, within 3 years. Right now, PCAOB cannot audit all Chinese companies listed in the US exchange because Chinese regulators restrict foreign regulators such as PCAOB from auditing Chinese companies due to national security concerns. I believe there's a small chance of Alibaba getting delisted from the US stock exchange for these reasons. First, Alibaba is already using one of the big 4 accounting firms, PwC Hong Kong, to audit its financials. Second, I believe US and Chinese regulators will eventually reach a compromise to allow PCAOB to audit Chinese companies' financials without violating Chinese regulations. Third, there are 217 Chinese companies listed in the US stock exchange with a total market cap of 2.2 trillion. This is about 6% of the entire US stock market. It would not make sense to delist all the Chinese companies from the US exchange because they cannot be audited by PCAOB within 3 years. This will have a huge economic impact on US investors, especially the largest US institutional investors that have invested billions of dollars in Chinese stocks. Alibaba is also listed on the Hong Kong Stock Exchange. I believe the worst case scenario is that Alibaba ADS shares in the US will likely be converted or transferred to Alibaba shares in the Hong Kong Stock Exchange. Risk number 3. How will Ant Group's suspended IPO impact Alibaba? Ant Group was supposed to be the largest IPO in history, but it was suddenly suspended by the Chinese regulators right before the IPO date in early November this year. So all this happened 1 week after Jack Ma made a speech at the Bund Summit 2020 in Shanghai. Jack Ma argued that the Chinese regulators' current financial system is restricting innovations and is not taking enough risks. He criticized the current banking system in China still using the same pawn shop mentality, meaning banks are still relying on pledge and collaterals in order to lend to borrowers. So here's the interesting part. According to this translation from Apple Daily, Jack Ma suggested a new credit system based on big data that will replace the current Chinese banking system based on collaterals. He said it is impossible for the pawn shop mentality of collaterals to support what global development demands of finance over the next 30 years. We must leverage our technological capabilities today and build a credit system based on big data in place of the pawn shop mentality. This credit system should not be based on conventional IT infrastructure or acquaintance societies. It should be based on big data to ensure that credit truly equals wealth. Here's the important part. Alibaba owns 33% of Ant Group. Now you may wonder, how will Ant Group's suspended IPO affect Alibaba? I believe Ant Group's suspended IPO has little impact on Alibaba's long-term growth prospects, because Ant Group was already spun off as a separate company in 2011. Suspending Ant Group's IPO means that Chinese regulators will have more scrutiny and oversight on Alibaba and Ant Group going forward. Both companies have near monopolies in China, each owning approximately 50% of market share in their markets. Alibaba's long-term growth prospects and e-commerce market. In my previous video about Alibaba, I talked about Alibaba is a near monopoly in China and why I believe Alibaba will eventually reach 1 trillion in market cap or $382 per share. According to eMarketer.com, Alibaba had an e-commerce market share of 55.9% compared with JD.com's 16.7% and Pinduoduo's 7.3% in China in 2019. eMarketer also estimated that Alibaba, JD.com, and Pinduoduo have 83.6% of the retail e-commerce market in 2020, up from 80.3% last year. Also, eMarketer estimated that China's total retail sales are now at 5.072 trillion compared with the US 4.894 trillion in 2020. This means for the first time, China is likely to exceed the US total retail sales in 2020. China also has the largest population in the world, as well as the largest e-commerce market in the world. According to Active Consulting and this article from Forbes, 58% of global e-commerce is concentrated in just 6 companies, and just 4 Chinese companies account for almost half of global digital sales. In terms of total global online gross merchandise volume in 2019, Taobao had a market share of 15% compared with Tmall's 14%, Amazon's 13%, JD.com's 9%, Pinduoduo's 4%, and eBay's 3%. Alibaba owns both Taobao and Tmall. So what does all of this mean to you? It simply means that the largest e-commerce companies in China, including Alibaba, JD.com, and Pinduoduo, will continue to benefit from more and more customers shopping online using their smartphones. And also they're benefiting from China having the largest retail market in the world that is as large as the US. This means Alibaba, JD.com, and Pinduoduo's e-commerce sales will continue to grow for many years. Summary, what I will be doing going forward with all this information. First, in the short term, I believe the current political risk will continue to cause Alibaba to be undervalued compared with JD.com and Pinduoduo. Alibaba will likely get fined by the Chinese regulators because of the anti-monopoly probe. The worst case scenario is that the maximum fine will be 10% of Alibaba's last year's total sales. This means Alibaba's net profit will be much lower for that year. But this should not impact Alibaba's long-term growth in the Chinese e-commerce market. Second, I believe there's a small chance of Alibaba getting delisted from the US exchange 3 years from now. I believe the worst case scenario is that Alibaba's ADR shares traded in the US stock exchange will be converted or transferred to Alibaba's shares in the Hong Kong Stock Exchange. Third, Ant Group is already a separate company from Alibaba, even though Alibaba still owns 33% of Ant Group. As long as the Chinese regulators are not forcing Alibaba to break up its businesses, I believe Alibaba's e-commerce businesses will continue to grow in revenue and net profit for many years. Fourth, what I will do going forward. I have been a long-term investor in Alibaba for many years since it went IPO. I am not planning to sell my Alibaba ADR shares because I believe these political risks do not impact Alibaba's near monopoly economic modes and its long-term business prospects. But to reduce risk, I always keep my exposure to Chinese companies to less than 10% of my entire portfolio, because political risk and regulations are always the biggest risk factors for most Chinese companies. Around 90% of my portfolio is always in US tech stocks such as Apple, Amazon, Tesla, Microsoft, Google, Facebook, and several more. The US financial market is much more established and stable than the Chinese financial market. For example, the US established its Sherman antitrust in 1890, while China only introduced its anti-monopoly law in 2008. This is why I always focus on investing in the best US companies and have a small exposure in the best Chinese companies, less than 10% of my portfolio. Also, I always invest for the long term to reduce risk. If you like this video, hit the like button and subscribe and turn on the notification button. I will continue to make many great videos about stock investing and personal finance that will help you become a great investor. This is Victor from the Intelligent Investor channel. Thank you for watching.